And joining us now is Tom Fullerton, Professor of Economics and Finance at UTEP. Professor Fullerton, first of all, thank you very much for taking the time, being with us here today and shedding some insights. I'll start with a question that everyone is asking, and economists like yourself really can only predict. Do we think there's going to be a rate cut come September, and what factors are at play here?
I think there is going to be a rate cut of the federal funds rate in September, like you mentioned in the introduction. It'll probably be 25 basis points from 4.5% down to 4.25%. Unfortunately, I think this rate cut is premature. There's a lot of inflationary pressures that are lurking out there in the economy, and this is one that the Federal Reserve may come to rue, even though there was a weak labor report last month.
And we see a lot of uncertainty, and there's others like Morgan Stanley who, of course, see a rate reduction in September as more like 50-50 whether or not it's going to happen. When we talk about the Federal Reserve cutting or even in some cases raising rates, what exactly are we talking about in the effect of how it affects the average El Pasoan, especially those who are looking to borrow money for whether it be a house, a car, or whatever it might be?
Well, let's see, when the Federal Reserve cuts the federal funds target rate, that affects short-term rates. Federal fund target rate is the rate that banks charge to each other on overnight loans that they essentially use to make sure that they follow the reserve requirement regulations that they have to follow. But it does impact on a lot of other interest rates, but mainly at the short-term end of the interest rate spectrum. Long-term interest rates, they have tools that can do that in terms of quantitative tightening or quantitative easing, but they don't use that very often, and they haven't used that much in the last 12 months, and they're not going to start using it now. So in terms of what rates can, get affected and may show up in terms of consumers, it's possible that it will affect credit card rates, bringing them down just a little bit, but not by enough to really become noticeable. The real risk here is that if this cut turns out to be premature, then they'll have to backtrack if inflation rises too quickly. And there's a lot of things out there that may cause inflation to accelerate. And
you mentioned those long-term loans. This is more short-term. It's not a direct correlation, but somewhat. This is also of note for people who, of course, again, maybe looking to buy a home, or maybe they're looking to refinance the rate of their home, and everyone kind of goes back to those pandemic levels that we saw. In your opinion, will we ever again see 2-3% interest rates again in the housing market?
Not until inflation comes under control for a substantial period of time. Right now, mortgage rates are probably going to remain right around where they are, in part because the financial markets are getting a little spooked by the ongoing threats towards the Federal Open Market Committee and the Board of Governors of the Federal Reserve. There's a long history throughout the world, and even to a certain extent here in the United States, of strong-armed political leaders influencing monetary policy in manners that, match up with their short-term political prospects, but end up translating into worse economic performance in the medium and long term.
How would you characterize the state of the economy right now? We talked about inflation. It is down compared to this time last year, but we'd like to see a longer period of that. The job market showing signs of growth despite a slight increase in unemployment this past month. It seems like we get a lot of mixed signals to the overall health of the economy as well as the market.
Well, the overall health of the economy is still fairly good. It's not nearly as strong as it was back in December. But right now, things have, the wheels are still on, as we said in our last Borderplex Business Barometer report. What is concerning, however, is that in terms of the El Paso Household Economic Stress Index, it's been slowly moving upward over a period of time. And right now, the index is not in, the dangerous territory. It's not like Robert's misery index from the weather report just a few minutes ago, but it has moved up, and for every 1 point increase in the household economic stress index, that translates into $3.3 million losses in terms of overall retail activity here. So we're not in the danger zone. We're not like we were, say, back in 2009 and 2010 after the banking crisis in the United States, but we have started moving in that direction, and we're kind of in the moderate range at present.
Hey, point to you for incorporating the misery meter on there. Professor Fullerton, thank you for joining us today and sharing your insights. We'll certainly do this again with you soon.
Andy, have a good evening.
All right, Tom Fullerton, Professor of Economics and Finance over at UTEP.